Good morning. Ladies and gentlemen, it's my pleasure to invite Dr. Umar Swift, CEO of Revolve Malaysia, to present his welcome remarks in conjunction with Ring the Bell for Investor Week 2020.
Very good morning and a warm welcome. Thank you for joining us at this morning's Ring the Bell for Financial Literacy ceremony in support of World Investor Week 2020. Ring the Bell for Financial Literacy is a global initiative by the International Organization of Securities Commission and the World Federation of Exchanges to raise the awareness about the importance of investor education and protection. And we are pleased to host today's special webinar, Informed Investing and the Path to Wealth Creation. At Bursa Malaysia, we have a strong commitment to advocate financial literacy in our marketplace and the wider community. Financial inclusion is best achieved with greater empowerment through education. Now more than ever, the need to manage your finances and investments efficiently have become more important in the face of growing uncertainties. In the current economic climate, building wealth may have to go beyond traditional forms of investment, such as fixed deposits or even real estate. Investing in the stock market is something that investors should consider. It is a platform that can achieve sustainable wealth. It serves to promote growth and the development of the economy. Yet many people still feel uncomfortable in going into the stock market. Warren Buffett believes investing as an analogy to growing a tree. You may plant seeds today, but you have to wait many years to enjoy the shade. For example, you don't dig up a tree every quarter to check on its progress. Nothing much would have changed. In that brief time, you might even have harmed the tree. Instead of worrying about market's movements or thinking the need to rush and chase the market, do take your time to familiarize your understanding of the market. Do not blindly follow the herd. Never invest in what you do not know or fully understand. Your needs and risk appetite before deciding on your next course of action. Invest for sustainable long-term growth, learning to become a savvy investor. Becoming an informed investor allows you to discover opportunities that may present itself as a result of evolving situations. What is interesting is the COVID pandemic has accelerated the use of digital technology to effectively reach a large segment of the population, resulting in greater financial inclusion. Please make use of content-rich platforms offered by the exchange, such as Bursa Academy, Bursa Marketplace. Bursa Academy caters to investors at all levels and allows you to learn at your own pace, whether it's equity, derivatives, or Islamic markets. This year, given the challenges posed by the pandemic, we've converted all our education efforts into a digital format. We are facilitating webinars that can help you gain a better understanding of investing until mid-2020. Finally, in conjunction with World Investor Week 2020, the Securities Commission will once again host Invest Smart Fest from the 23rd to the 25th of October this month. Held virtually, Invest Smart Fest theme, Silap Labor, Do It Lebur, will feature various talks and panel discussions by leading industry experts who will share insights on the capital market and investment opportunities. The three-day event will also showcase products and service offered by the capital market, including stocks, unit trusts, and even P2P financing and digital assets. To know more, you can visit InvestSmartFest website, www.investsmartsc.my. And on that note, ladies and gentlemen, I wish you a very productive session. Thank you very much.
Ladies and gentlemen, it's my pleasure to invite Dr. Umar Swift to ring the bell to signify a support for financial literacy in conjunction with World Investor Week 2020. Ladies and gentlemen, the striking of gong will also mark the start of trading day at Bursa Malaysia. Let's do the countdown now. 3, 2, 1. Thank you very much, Dr. Umar Swift. Ladies and gentlemen, it's now my pleasure to hand over to Mr. Choo to proceed with the event proper. Thank you. Have a pleasant day ahead.
All right, so that was Dr. Umar Swift, the CEO of Bursa Malaysia, that gave an opening remark. So good morning, everybody. Welcome to this webinar brought to you by Bursa Malaysia. And just allow me to share my screen right now. So first of all, I want to thank Bursa Malaysia for organizing this webinar Informed Investing Path to Wealth Creation. So today we are very excited to be speaking on this topic called Informed Investing Path to Wealth Creation. I'm sure for those of you who are tuning in online right now, could you just say hi? Could you just say hi to us and also tell me where you are logging in from? Okay, let me know in this early morning where you are logging in from. Okay, we have Lillian from Ipoh, Sulin from KL. Wow, we have Rabiatu from Teluk Panglima Garang. Okay, Michael from Malacca, thank you. From Puchong, KL. All right, cool. Thank you so much for tuning in the early morning at the start of trading day on Bursa Malaysia. This is Choo streaming live from the Bursa Malaysia office. All right, so without further ado, let's just go quickly into the disclaimer. So whatever we share on the with you on this webinar is only for educational purpose. In no way that I will give any buy or sell signal to any stocks. So in the event that you want to buy or sell any company, you do it at your own risk. So allow me to briefly introduce myself. My name is Choo. If you have followed our Bursa webinar for a while, you'll notice that I am the moderator for this webinar. But today, I'm going to speak on this topic called Informed Investing Path to Wealth Creation. I'm a financial speaker, trader, and investor with 10 years experience trading and investing in local and international stocks, ETF, and currency. I'm also a certified professional trainer by IPMA UK. As a speaker, I speak regularly for Bursa Young Investor Education Seminars, investment banks, and technical charting companies. I also design and conduct stock simulation games and workshops for Bursa Malaysia nationwide. And today, I've trained over 10,000 individuals in stock investment. I'm also a frequently invited guest speaker for over 20 universities nationwide to teach investment. And currently, I was invited quite regularly on City Plus FM to comment on the market. So that is a little bit about myself. And are you ready to get started with what we're going to do today? So today we are going to talk about the common mistakes of retail investors. What are the 10 mistakes that retail investors always make? And secondly, we're going to talk about target setting to achieve your own investment goal, because different individual has a different investment objective. So today we're going to talk about how you can set target to achieve your own investment goal. And thirdly, we are going to talk about the habits and traits of an informed investor. Okay, so long that we adopt these habits and traits, then we'll be able to build sustainable wealth through the capital market. And fourth, we are going to talk about some of the tips and techniques when it comes to managing your emotion when investing. All right, so are you ready to get started? All right, now, just as you heard from the CEO of Bursa Malaysia, who talked about avoiding herd mentality, so that the reason Bursa Malaysia organized this webinar for you is because we want to encourage the retail investor public to be able to make independent judgment, but not just hear from what people say. So we need to learn how to avoid the herd mentality, but have independent judgment, so we'll be able to make a good judgment. Because what your friends tell you, what's the tips that you hear from, may not be able to to consistently help you to make money, because some people just hear the rumor, and some rumor, when it is spread wrong enough, it become believable. So for us as a retail investor, we need to know how we can read, able to dissect financial reports and understand the news, understand the facts that were released by the listed companies, and be able to make independent judgment without just purely or blindly relying on your friends' tips. Now, as you know, our life revolve around stock market. Okay, if you look around ourselves, okay, we see that we have every day when we wake up in the morning, we will have maybe use listed company product. For example, you wake up in the morning, you switch off the aircon. It probably is a Panasonic aircon. Panasonic is also listed on Bursa Malaysia, and then you switch off Panasonic aircon, and also your alarm rang. Okay, it could be an iPhone. And iPhone, we have a lot of listed companies that supply the modules or the chip to the iPhone maker. And then we go to work, we drive our car. Our car are probably manufactured from publicly listed companies, and we eat or we probably take our breakfast, we drink Milo. These are all our listed company product. We make a call. These are all telco listed companies. So our life revolves around listed companies. So instead of becoming a consumer, why don't we also think along becoming an investor? Now, as many of you, I'm sure that many of you here have already started investing in the stock market. So you will have known many listed companies that you may be a consumer of, right? And for retail investor, right, oftentimes if we are not careful, if we just hear what people say, if you just hear from tips, then we might risk our hard-earned money to lose in the stock market. So retail investor do lose money. It's not all retail investor. Maybe you've seen your friends making 100% return, see your friend making 200, 300% return. You thought you thought you can be a bit more not so careful, but in fact, those people who build sustainable wealth through the stock market are always very careful with what they invest in. Okay, they do their due diligence, they study the company that they want to invest in before they really put their money in. So retail investors do lose money. So let's talk about what are some common mistakes that retail investors always do that cause them to lose their hard-earned money, and see and assess for yourself whether do you make this kind of mistake. So number one, follow the herd, which is what we talk about and the CEO of Bursa Malaysia talked about just now. So we should be able to make independent judgment, not to only follow the herd. Maybe you have your friends telling you that, oh, this company are very good, just started a glove manufacturing manufacturing hub. Okay, so and then you, without doing your due diligence, you really put your hard-earned money into this company newly just have a new venture into the glove manufacturing business, and then you follow the herd. Then eventually when the tide turns, then you lose your hard-earned money. So number one common mistake that retail investors always make is follow the herd. Okay, because they don't know how to read financial reports, they don't know how to dissect the statements to the bone, they don't know how to make sense of the number and also the corporate announcement, and then so they rely on tips. They rely on their friends, their auntie, uncle, the pasar, the people, the stranger tell you that, oh, this stock confirm go up. So when they tell you this stock confirm go up, then you also without really studying the company that they mentioned, you put your hard-earned money into it. That then maybe out of 10 companies you put in, 5 of them that lose really big. So this is a first common mistake that retail investors make. Number two, retail investors always like to listen to tips and rumors. Okay, we always rely on tips and rumors, and then when people buy them, we follow. Number three, retail investors like to do contra trading. All right, contra trading is a privilege that some investment banks and securities firms offer to you. So contra trading will mean that you buy on the T day and then you sell on the T+2. Okay, so contra trading doesn't involve really big capital. So a lot of people, because retail investors like to make money fast, so they commit. They fall into a contra trading. So when you do contra trading, because you have the urgency to sell by T+2, so sometimes you might make error in your judgment. Okay, so sometimes good companies may not appreciate in 2 days. So good companies will take some time for the market to realize the true value. So if you do contra trading, then it is a time that we lose money, and not only we lose our money, then we can also lose quite big in terms of our transaction fee. Number four, choice of stocks. Okay, a lot of retail investors like to invest in the wrong choice of stocks. What are stocks that they like? Number one, they like the penny stocks. Okay, so ask yourself, do you make this mistake or not? Okay, do you make this mistake? Do you like to invest or trade in the penny stocks? Penny stocks are stocks that are a few cents. Okay, for example, a 5-cent stock, if a 1 cent move, is already represents 20%, because the movement is very drastic. So it gives us the adrenaline rush. Okay, we will feel very excited. Now, of course, when it comes to investing, if you feel that you're having excitement, then you're not investing, you're gambling. Do you agree or not? Okay, let me know if you agree. Let me know in the comment. Okay, if you agree, let me know in the comment. If you are having excitement, actually you are, not investing, you are gambling in the market. So investing, the real investing should be boring. Okay, because if you really want
Profile.
excitement, you go to
Profile.
Genting, okay? Go to casino. If
I
you
give it to
if
you.
you want
Just
to really
confirm with you because there's a
stable
changes.
wealth, go
I
do it
have that old
through
one.
the stock market uh way. All right. Don't treat the stock market like the casino. So for us, not only we need to buy, for retail investors, uh, we need to avoid those companies without good solid fundamental, because by avoiding companies without solid fundamental, then we'll be able to put our money in the useful place. All right. So number 5, no self discipline. Okay. Many retail investors like us, we have plan, but many times we don't follow through our plan, and because what happened was we let emotions to affect us. Okay, we let emotions to get into our way of investing. So when it comes to investing, let's say we want to buy this stock at 5 ringgit, but then you see the stock price never declined to 5 ringgit, it keep going up to 7 ringgit, 8 ringgit, then tak boleh tahan already. Okay, you cannot contain your urge, then at the end you buy at 9 ringgit. Okay, you did not follow your plan, even though your plan was to buy at 5 ringgit, but because the market keep going up, so you cannot resist the urge, and then you invested actually at 9 ringgit. So that was the time where we defeat our own plan, and we did not have enough self-discipline. Okay, so this is or if you already set a cut loss point, okay, you already want to cut loss at say 3 ringgit, if it falls like 10%. However, because you are very hopeful, when the market drop, you still feel that there's a chance for it to rebound. So you actually did not follow through your cut loss target. Okay, so when you reach 3 ringgit, you did not cut loss, and you let it plunge a bit more until you reach out, let's say 1 ringgit 50 cent, then you actually regret. Okay, you should when will you cut loss? You will only when you're hopeless, then you cut loss. All right. So that's what retail investors always do. Okay. So know have self-discipline to stick to the trading plan. Number 6, want to make money fast. Okay. Now retail investor always take Bursa Malaysia or the stock market as a place for us to accumulate, for us to make money fast. Okay. But remember this, stock market is not a place for us to become rich overnight, but it's a place for us to build sustainable wealth. So we should not treat the Bursa Malaysia like a casino, but we should treat Bursa Malaysia or the stock exchange as a place for us to build sustainable wealth. All right. So number 7, no patience. Okay, when we do investing, we actually expect, a retail investor always expect, today I buy the stock 1 ringgit, tomorrow it should go up to 1 ringgit 20 cent. Okay, no, actually it doesn't work that way. Sometimes the true value of the company will only be reflected in the share price over a longer period of time. Okay, so as retail investor, we need to have patience. We need to have patience to be able to wait until the market realize the value. Okay, not like today you invest, tomorrow it will go up. Okay, so this is not the case. So always retail investor have no patience, and then or when you buy 1 ringgit, when the price go up to 1 ringgit 20 cent, you take profit. Okay, you just feel 20% good enough, you take profit. Okay, but then actually the company still have the potential from 1 ringgit actually all the way go up to, let's say, 4 ringgit. Okay, so you miss out on all the huge gains if you take profit too early. So we have known that some of the big companies like Public Bank, those days were only like 1 ringgit or so. So if you only sell Public Bank, let's say at 2 ringgit, then you would regret until today, because now it's about 15, 16 ringgit, right? So as a retail investor, we need to have patience, not to take profit too fast, but follow the fundamental. Okay. Number 8, overly greedy. Okay, we want to make money fast, and then we are overly greedy. So and then overly greedy will means that when you when the share price has become overvalued, but you still don't want to sell, okay? You still want to hope that it can go even higher, okay? Don't know when to take profit, okay? So this is over greedy. Number 9, don't cut loss. You just now I think I briefly talked about cutting losses. So the 9th mistake is that retail investor always become very hopeful. When their judgment is wrong, they still do not want to cut loss. Okay, so this is 9. Later we'll talk a bit more on cut loss. Now 10 is frequently buy and sell stocks. Okay, we frequently buy, frequently sell, and then the trading become more frequent. So when we do so frequently trade and sell, buy and sell like contract trading, then they will have paid a lot more of a transaction cost in the area of stamp duty, clearing fee, brokerage fee, and also the stamp duty, clearing fee, brokerage fee. Okay, and also SST. Okay, one more is SST. So these are the 10 common mistake of retail investors. Okay, so we like to follow the herd. We like to listen to tips and rumors. We like to do contract trading. We always invest in a wrong choice of stocks. Okay, without good fundamentals. We don't have self-discipline. Even though we have a plan, we never stick to our plan. We want to make money fast. We treat stock market like a place to be rich quick tomorrow. Okay, we have no patience. We are overly greedy. We don't know when to take profit. Okay, we don't cut loss. Okay, we are very hopeful. We don't want to cut loss when we have a paper loss, and we frequently buy and sell stocks. So this is 10 common mistake of retail investors. So tell me, let me know honestly, which one you do the most or you commit the most. Okay, let me know. Is it number 1, number 3, or number 10, or number 8? Okay, let me know in the comment which one do you think is your mistake. Okay, so okay, some people say 9, some say 4, some say 7. Okay, 5. Okay, I think 9. A lot of people are 9, don't cut loss. All the above. Okay, from our friend here, Wong. Okay, all the above. Okay, well, many people say don't cut loss is the mistake, huh? So now, is investing really risky? Okay, so this is the question. Now, actually, investing won't be so risky if you know how to avoid the risk in investing. Now, number 1, people always say, we're very worried about investing in stock market is price will crash. Okay, if I invest in the property market won't crash. Okay, but in the stock market, one ringgit stock can go down to 50 cents. Okay, so this is like 50% loss. Okay, so this is one concern in the stock market, but actually we can avoid this risk by solution. What is the solution? We avoid the bad companies. We only invest in companies that have good fundamentals. Okay, so we only avoid companies that are strong, they are growing their profit, that has good liquidity, that have a good solvency, low debt, and then they give high dividend yields. Then if you follow all these criteria, you will avoid bad companies. When you avoid the bad companies, then you'll be able to avoid all this volatility in the stock price. So that is number 1. So number 2, volatile. Okay, some of you feel that stock investing is very volatile. So our solution is we do diversification. Okay, so you won't see that if your whole portfolio is only invested into 1 or 2 stocks, then you will see a drastic change in terms of your paper gain and paper loss. So what we can do is we diversify. So when we diversify, we reduce our risk and we can get a more stable return from the stock market. Number 3, people feel that the management can trust one man. Okay, so sometimes they cook the book. Okay, so what is the solution? The solution is we have to select the management with integrity, who looks after the minority shareholders. There are a number of companies who really display high level of ethics and integrity when it comes to the business dealing. So what we need to do is select to really know who are the management behind the companies. We must study the board of management, board of directors, the key management, the senior management, and see whether they have been making wise business decisions or not in managing the company. So pick the one. So if you are invited to the AGM, at least attend the AGM. Okay, make time. Okay, maybe take a late day off. Okay, to attend the AGM. Okay. I sometimes drive all the way down, okay, just to meet to attend the AGM and see what the management says. So when you are actually seeing sometimes when you see people eye to eye, right, then you'll be able to know whether this guy is a crook or not. Okay, so when when you're able to meet somebody, you see them eye to eye, then you know that, oh, this guy can trust, this guy cannot trust. Okay, so we have instinct, right? So the least you can do is to at least attend the general meetings or the AGM to see who are the employees that you hire. Okay, you get what I mean? Because as the shareholder, you're like officially the owner of the company, one of the owners of the company, so you must know who are the management and who are actually drawing salary from the company and who are managing that. Do they have integrity or not? So what happens when you find that the management that you invest in do not have integrity? What do you do? You just sell the company. Okay, you just sell the shares the next day and then don't hold on anymore. So because the management is very powerful, okay, a management can really turn around the company if they really have a solid plan. But the management can also sink the company if they have they don't display the highest standard of ethics and integrity. They receive kickbacks, okay, they involve in corrupted practices. So these are the risks that we can avoid by selecting management with integrity. Number 4, don't have first-hand information. Okay. So what is our solution? Pay attention to corporate news and operating environment. Attend AGM. Now, this is the truth. The truth is that always the management have the first-hand information. Okay, the people inside the company have a first-hand information. As a public investor ourselves, we may not have a first-hand information. So what we can do here is to follow closely with the corporate developments, with the corporate news, and also the operating landscape for that company. Okay, and also attend AGM so we can know what is the outlook of the company, what the management feel about the company. So when they feel that the company outlook is not so good, they may use a term like, the operating landscape remain challenging. Okay, so when they say challenging, so you must know that it won't be a smooth sailing for that business. Okay, so we have to always pay attention. Okay, if you're reading newspaper, always focus more on the business segment. So you can read more on business news on The Age, okay, on the Starbiz and so on. So this is the place where we can get updated corporate information. And of course, go to Bursa Malaysia listed company announcement segment, so you can read up the relevant corporate announcement released by the company. Okay. Number 5, investor always find that investing is very one of the risks is speculative. Okay, so what is our solution? We don't speculate, but we invest in the stock market. Okay, we don't speculate, but we invest in the stock market. So then the stock market will not be so speculative. Okay, so we don't want to find penny stock that want to go up. Okay, but we really pick good companies, because the penny stock that go up, maybe if you are the last one who leave, you are the last one who leave the market, right? Then you'll be stuck at the highest floor of the condo. Okay, 住套房啊, this is what people say. Okay, so we must really practice prudent investing by not being speculative. Okay, so these are some areas and some solutions where we can avoid the unnecessary risk when it comes to investing. Now, so how much return should we target as a retail investor? So now for target setting, right, every one of us is different. Okay, because each one of us have a different lifestyle, and each one of us have a different desire in life. So we must set a target that is reasonable. Okay, so number 1, the first step to set target is you must know what is your beginning capital for investment. Okay, you must know how much is your beginning capital for investment. So if you know that right now you have let's say you have 50,000 to start investing, then my beginning value is 50,000. Or if you are just a newbie, your early 20s, then maybe your capital is not so huge, so you might imagine as maybe 5,000. Okay, for your capital investment. So number 1 step, determine how much capital you have for investing. Number 2, You must think about your desired lifestyle in the future, your family plannings, and your children educations, your retirement, and all the things you love to do that will cost a huge sum of money, and estimate how much those will cost you. So this is the second question that you need to ask yourself. So ask about what kind of lifestyle you want to live in the future. Okay, so do you want to send your children to a boarding school, or to a prestigious university overseas, and then how, when you retire, what kind of lifestyle you want to maintain, what are things that you love to buy and you love to do, how frequent you want to travel in a year, and how much, estimate how much you need. So for example, you will need that you want to you want to retire at retire in let's say in Penang. Okay, so you want to buy a house in Penang, so estimate like how much that house will cost you. So just have an ending value. Okay, if you think that to live comfortably after retirement I need 5 million. Okay, this is maybe this too much for some of you. Maybe you just say that I need 2 million. Okay, just estimate. Let's say right now you have 50,000 to start, and then by the time you retire, you need to save 2 million to maintain your lifestyle. Okay, so that is your ending value. Then third is you need to determine how many years you have to accumulate that amount of money. Okay, but of course also set aside some money for maintenance of health when you are towards the retirement age. Maybe you have more your body is not as fit as those days, so also set aside some money for health. So right now, let's say you are 30 years old, and then you want to retire at let's say 55. So you have 25 years to accumulate 2 million out of a 50,000 kind of capital. So when you have a beginning value and the ending value, then you will know how much you can estimate how much annual return you need to enable you to live your desired lifestyle. Okay, so so this is one thing. So you can use compound annual growth rate calculator for you to know that this is the kind of return you need to get in a year. So if let's say let me see. So one of the example, let me show you one example you can go to is to find compound annual growth rate calculator. So let's say your startup capital is, let's say 50,000, and then your ending value you want to have 2 million, and then you have how many years? Let's say 25 years to achieve that. Okay, then you calculate. On every year, you need to make 15.9%. Okay, so your money from 3,000 will compound to 2 million by the time you retire at 55 years old. So this is the output. Okay, you need to have 15.9%. Then you know 15.9%, what kind of portfolio should you build? Okay, you can build 15%, right? You can build maybe half portfolio is in the blue chip stock, and the other half, sorry, maybe 40% in blue chip, 60% in growth stock. Then you'll be able to reach maybe 15.9% a year. So let's say you have, let's say your starting value is 100,000. Okay, is it 100,000? Okay, no, this. Okay, your starting value is 100,000, and you want to build to 2 million. And the same thing is you have let's say you have more times. Okay, you have let's say 28 years. Okay, you want to retire. Let's say right now you are 32 years old. You want to retire at 60 years old. So you have 28 years to achieve 2 million with a startup capital of 100,000. So you click calculate, then you will know your compound annual growth rate is 11.29%. So you only need to achieve 11.29% return to build from 100,000 to 2 million. So what kind of portfolio should you build? If 11% is even easier, you can invest more. Let's say 70% of your stock is in blue chip stocks such as a public bank, Maybank, or Tenaga, or all the blue chip Top Glove. Okay, and then the other 30% could be put in the growth stock. Okay, it could be a growth stock, could be like Penta Master, okay, Franken, or Me Equipment, Great Tech. Okay, so these are some companies that can put your money in for the 30% of the portfolio. Okay, so each one of us will have a different target. So what I want to challenge you to do is to think about how much capital you have right now and how much you would need to live your desired lifestyle post retirement, and then you know how much longer you have to accumulate that amount. Then you calculate how much return you get. Now, hopefully it is still within a reasonable and achievable range. So if you let's say you have 2,000 right now, you want to accumulate to 5 million in, let's say, 5 years, then of course your return on investment will be really huge. So if our return on investment is not so huge, required return of is not so huge, then we don't have to take unnecessary risk. Okay, because investing in a high growth stock is highly risky. It's more risky than investing in a investment grade blue chip stocks. So this is each one of us is unique. Okay, each one of us must know our number. So this is financial planning. Okay, you must know exactly how to achieve your goal. Okay, so sit down, really think about, discuss with your spouse. Okay, think about what kind of lifestyle you want to live post retirement. Okay, estimate the kind of the cost that will incur to you. Then you will know how much return what kind of portfolio you should build. Now, so this is another simple trick that you can learn, which is the rule of 72. Rule of 72 say that if you take 72 divided by the rate of return, so that will be the time required for your capital to double. Okay, so let me give you an example. So for you to double your money in 10 years, how much return you need? Okay, you need 7.2%. So if every year your portfolio generate you 7.2% return a year, then in 10 years you'll be able to double your money. So that means let's say you put in 50,000, in 10 years you become 100,000, right? But 7.2% maybe is a little bit low, You may want to target higher. So if you want to double your money in 5 years, then the rule of 70 will tell you that your return will be 14.4%. So you'll be able to double your money every 5 years. So what are the habits and traits of an informed investor? Okay, so trait number 1 is informed investor don't blindly listen to tips. Now, informed investor always want to do our due diligence on tips. Now, in the market, we are never short of tips. Okay, there are a lot of people who tell you what to buy. Okay, and of course, especially for me, my circle of friends, right, always talk about stocks. So I always hear this guy say, that guy say, this stock can, this stock cannot. And of course, people also ask me what stock can buy. Okay, so I am, we are never short of tips. So what we need to do is don't blindly listen to tips. Okay, every time, even if I have friends or trusted remisers who tell me to can look into which stock. Okay, so what we need to do is to do your due diligence. So sometimes your remiser will, you will seek your remiser advice, and then your remiser will give you some advice or give you some tips. Okay, so what you need to do is just don't blindly follow the tips. So what you need to do is whatever stock that he or she mentioned, we need to really do our due diligence. Okay, we need to study. Okay, study what is the company. So one mistake that people always make is they don't even know what company they invest in. Okay, or they buy this stock. Oh, okay, I buy Great Tech. So what Great Tech do, I don't know. Okay, for example. Okay, so you don't know what business the company invested is involved in. So for retail investor, we always need to know what business we invest in. Okay, because when we know the business, what business is in, so we know what are the risks that can affect that particular sector. So whenever your friends or wherever you heard some people talking about this stock, confirm go up. Okay, confirm go up. You also don't want to blindly follow. So sometimes people say confirm go up, then you all in. Okay. Okay. Recently, I think I heard this term called "hut gao yi" or something like this. Okay. So don't really want to put all your egg in the one basket. Okay. So when you heard somebody mentioning about some stock, must remember, study the company, Okay, every time my friend tell me, I also study the company, see whether I agree with the judgment or not. If you agree with the judgment, then maybe you feel that, okay, well, it's worth the risk, then you put your money in. So that's number one. Don't blindly listen to tips, but always do your due diligence on tips. So this is habit number one. Habit number two, don't borrow to invest. Okay, we must always invest with the amount that you can afford to lose, because if we invest with the amount that we cannot afford to lose, then we will be very emotional when it comes to you know getting the market volatility. Okay, so every time, let's say this is a very important money to us. Okay, let's say this 100,000 is what you need to for the down payment for the house that you want to buy, for example. Okay, or 50,000 is the amount that you need to put down for your down payment. But however, you are greedy, you want to earn more, so you put this 50,000, which was supposed to be a down payment for your house, to in the market. So every time the market move, right, you'll be, oh shit, I actually don't have the I really don't have the money anymore. Okay, if it go down like 1%, 2%, you will be very emotional. Okay, so you feel like, oh, very stressed, huh? So when you invest with the money that you cannot afford to lose, right, so you will be very emotional. So tip number two is don't borrow to invest. Never borrow to invest. Now, unless you are really knowledgeable about debt leverage, unless you really know debt leverage well, for example, share margin financing, and are prepared for any possible adverse outcomes, then you must strictly follow these guidelines. Don't borrow more than 20% of your portfolio value. Okay, if you borrow more than 20%, then I would deem that is over leverage. Number two, only invest in investment grade companies. Don't use it on speculative stocks, okay, or highly risky stocks. If possible, use this debt leverage, invest in company whose dividend is more than the interest. Okay, because if the dividend is more than the interest, then at least when the share price goes south, don't go against you, then you won't be emotionally so stressed. Okay, so you'll be able to your return from dividend yield alone is enough to pay the service, the interest that you need to pay to the bankers. Okay, so if can, avoid investing unless avoid share margin financing, but unless you really know well, then you also don't borrow more than 20% of your portfolio value. So this is rule number two, never borrow to invest. Habit number three, informed investor always invest within our circle of competence. Okay, so we must, each one of us have our circle of competence. Okay, some of us here are more knowledgeable in the plantation industry because we work for a plantation company. Some of us here will be more knowledgeable in manufacturing line because we are in a factory. Or some of us here will be more knowledgeable in the area of tech space because we are in in the industry. Some of us here is the service industry. Some of here works for consumer fast FMCG company. So we are more familiar with the consumer staple stock. So each one of us will have our circle of competence, whether you are a housewife, whether you are working professionals. So each one of us have our circle of competence. So what we need to invest in is we must always invest within our circle of competence. Okay, so know your circle of competence and stick within it. So this is what Warren Buffett said. The size of that circle is not very important. Knowing its boundaries, however, is vital. So this is from Warren Buffett. All right. So if you're a housewife, then let's say you will go to supermarket, you will go to hypermarket to buy goods. So if you're a housewife, maybe you're familiar with all the prices. You know which brand or which brand got more sales right now. Okay, which brand people always buy right now. You will roughly know. Okay, whether it's Nestle, F&N, or Dutch Lady. Okay, what kind of product? Okay, Hapsing, Apollo. Okay, so what kind of brands people buy, then you will know. Okay, so this is the if the product is widely consumed, then we can actually know that this range of product will actually, the share price will actually may perform better because the business result will be better. So this is number 3. Invest within our circle of competence. Even though you are a housewife, you will still have the circle of competence within you. Habit number 4. Don't buy loss-making companies. Okay, so don't invest in consistently loss-making companies, no matter how cheap they are, unless the company is in a real turnaround state. Okay, now investing in loss-making companies really involve, having better skill, because loss-making companies, even though they are cheap, but they could be cheaper. Okay, cheap companies can become cheaper. Okay, don't think cheap companies can only go up. Okay, you buy into a company that's 10 cents, they may become 8 cents tomorrow. They may become 8 cents tomorrow, then you lose 20%. Friends, okay, don't buy loss-making companies unless you really know the company is in a state of turnaround. Okay, they are really being turned around. Then you can, because you really understand the company well inside out. You know the company inside out. If the company is really being turned around, then you can consider to invest in a loss-making company. Unless you are really knowledgeable about the company, then avoid buying into a company that loss-making. Okay. Number 5th, don't buy inconsistent companies. Okay, so these are the 5th trait of a successful and informed investor. We, as an informed investor, we want stability. Okay, so we don't want to invest in company that deliver inconsistent profits. So sometimes it's up, sometimes it's down. Okay, because when a company deliver inconsistent result, then it might mean that the business is not so stable. Okay, so but this is the exception for cyclical stocks. So when a company is in a cyclical stock, then they are subject to the cyclical nature. Then of course you will know when the cyclical trend comes, then you can follow the tide So if you don't understand the company's cyclical behavior, then don't invest in companies that deliver inconsistent profit. So what we want is companies that always, first year make 20 million, second year make 40 million, third year make 60 million, fourth year make 80 million, and last year make, let's say, 100 million. So these are companies that is predictable and then has a stable growth. Okay, so this is trait number 5. Trait number 6, diversifying. Okay, now diversification minimizes the impact that the performance of any one security will have on the overall performance of the whole portfolio. Okay, so many people here like to all in one stock. Okay, now this is a a grave mistake. Okay, of course all in will really make you give you huge return if you got it right, but it can also deliver you huge losses if you got it, if the market go against you. So all in is a very dangerous thing. I think all of you here would know the word all in, okay, or sai lang. Okay, so this is something that we want to avoid. Now, because investment carry risk, so to reduce our risk, one thing we can do is we must diversify, because diversification minimizes the impact of the performance of any security have on our overall performance of the whole portfolio. So when we diversify, then we'll be able to achieve consistent return. Okay, if we don't diversify, then you will see that your portfolio return is first year, let's say 60% gain, second year maybe lost 30%, next year make 40%, the following year lose 50%. So you can achieve this kind of inconsistency. So when we diversify, then our portfolio gain will become more stable. Then we'll be able to build a sustainable wealth through the stock market. Trait number 7, cut loss. Okay, so now when a successful investor or informed investor know when to cut loss. So when knowing that cut loss is painful, but actually it's also a necessary move. Okay, so we must learn how to cut loss. And just now when I ask you what kind of mistake you make the most, so many people will admit that it's cutting loss. Always don't want to cut loss, because cut loss is painful. Do you agree? Cut loss is painful, because if you don't cut loss, right, what do you have? You have hope, right? Okay, when you don't cut loss, you have hope, because you can still hope that the market will turn around and then you will have paper gain one day. If you cut loss, you realize a loss, and that is painful. You see that, oh, actually your portfolio is actually gone maybe 5,000 ringgit, okay, when you cut loss, okay, or gone 1,000 ringgit. That could be, you know, your 1 week salary. So cutting loss could be painful, but actually it is necessary. Okay, it's necessary when what? Number one, the company growth outlook has changed. Okay, so when you notice that the company growth outlook has changed, then you need to cut loss. So they are no longer, you know, as bright as it projected to you last time when you invested in. So you need to cut loss. Okay, when you realize you have made a wrong judgment of a company, so maybe you feel that, okay, oh, this one, the demand for the product and services will go up. But after 2 quarters, you still feel that, hey, actually no, the result decline, or maybe they are changing a business environment. When there's a changing business environment, then you will notice that you make a wrong judgment, then you should cut loss. Number 3, the company records a quarterly loss, and for the reason that had caused a quarterly loss will continue to dampen the stock. So when a company records a quarterly loss, then and then you notice that this reason can, you know, will still be here for some time, then you don't cut loss. So you have to cut loss. Okay, so what we want to avoid is, you know, is avoid being hopeful to the stock. Okay, hope that the company, you pray the company will still come back. The thing is, you know, of course, you know, of course, we of course we need to be you know, each one of us have the religion that we believe in, but you know, don't try to you know, be over religious in the stock market, because the stock market, right, is you know, it doesn't work that way. Okay, don't be hopeful and always pray that your stock will come back. Okay, when you make a wrong judgment, just cut loss. Okay, so what are some of the cut loss principles? Number 1, we don't need to be right all the time. Okay, we want to be profitable. Okay, you don't want to show to your friends that every time I invest, I confirm make money one. Okay, even the world's most successful investor will also make mistakes. Okay, like Warren Buffett will also make mistake at time. Okay, like recently Warren Buffett sold the airline stock. Now, why sold airline stock? Because Warren Buffett realized that the outlook for airline stock have changed. So Warren Buffett, you know, sell all the stocks. So when the outlook has changed, Warren Buffett, you know, even the world's most successful investor, will know how to switch their portfolio. Okay, so you don't need to be right all the time. You want to be profitable. To be profitable, you need to cut loss. So, like, you know, building a portfolio of stocks is like building, you know, if you love football, building a good football team. Okay, so sometimes you want, if a player underperform, you want to replace your player. You get what I mean? It's like building any sport team. Okay, if the player underperform that day, maybe they got, you know, maybe that day they are, you know, sick, they are ill, then you replace them with another player. So when the player is feedback, then you also can also replace, you can also reinvest into the company. So you don't need to be right all the time. You want to be profitable. To be profitable, you need to cut loss on the companies that outlook has changed, or you realize that you have made the wrong judgment. Number 2, don't be emotionally attached to your stocks. Okay, fall in love with the number, not the company. Okay, just because, you know, not just because you have invested in a company long enough, if the company outlook has changed, right, don't fall in love with them. You know, just, you know, get out. Okay, because emotion cloud your judgment and make cut loss harder. Number 3, you should manage your portfolio like how you should manage a company. A company is supposed to make money, so make sure that your portfolio does the same. Make sure your portfolio also makes money. Okay, so if you know, if let's say you have a few divisions in the company, if you notice that this one division is always loss making, then you may want to, you know, terminate that business division. So the same for your portfolio. If your one of the stock is always consistently underperform, then you want to cut loss. Okay, and switch the company the money to another company that's performing. Now, cutting loss can be painful as you realize loss, but if you don't cut loss, not only you will incur possibly more paper loss, but also incur opportunity costs. So for this stock, let's say you allocate 10,000 into this stock. Okay, if the stock underperform, okay, it lose money. Okay, from 10,000 go down to 9,000, go down to 8,000, go down to 7,000, and then you're hopeful, you still don't want to cut loss. You hold on to that stocks, okay? You hold on to that stock, then you see that another company appreciating. Actually, had you switch your portfolio from stock A to stock B, which is from stock A, which is underperforming, to stock B, which is performing, then you have broken even, or you have been profitable. Okay, so if you don't cut loss, you will only have paper loss. Okay, now some people really invest in what structured products, okay, like structured warrants, and when they are wrong, they just be hopeful. They hold, and then as the warrant run out, the time value of money runs out. Then when the warrant expire, then let's say they invest 10,000 into this warrant, become worthless, become zero. Okay, if you cut loss, maybe you walk away with 5,000. Your 10,000 become 5,000. If you still hopeful, hold it until the expiry, then you walk away with zero. You lose your entire amount of capital invested in warrant. So this is one mistake that investor make. So why do investors sell the winners and keep the losers? Okay, most investors do not have the patience. Okay, so always sell the winner and keep the loser. That's really this kind of behavior. Okay, so let me ask you. Let me just launch this kind of survey. Now, which one will you choose? Have a chance of winning 1,000. Sorry, have a 50% chance of winning 1,000 and 50% chance of winning nothing. A. B is sure win 500. So which one will you choose? Okay, let me know in the comment. Which one will you choose? Okay. A is 50% chance of winning 1,000 and 50% chance of winning nothing, or sure win 500. A or B? Let me know. A or B? Let me see the comment. Okay. Give you 30 seconds more to answer. All right, we have many people who pick B. Okay. Okay, Julie unable to comment. You just type here. When you type here, that means I can see. Okay, Julie Lee. Okay, unable to comment. So I can see your comment. So you just type A or B. Okay. Okay, B, right? I will say that from my screen right now. Majority of you will pick B. Sure win 50%. Sure win 500. So I was from my screen right now. I see 80% of you pick B. Okay, sure win 500 versus 50% chance of winning 1,000 and 50% chance of winning nothing. If you can see these two expected outcome is the same. If you take 50% times 1,000 plus 50% times 0, you get 500 as well. So expected outcome, expected value is also 500. So this one is sure win, confirm win 500. Okay, most of you here pick B. So let me ask you another question. Which one will you choose? Okay, A, have a 50% chance of losing 1,000 and 50% chance of losing nothing, versus B, sure lose 500. Okay, which one will you choose? Okay, 50% chance of losing 1,000, 50% chance of losing nothing, or confirm lose 500. Okay, A or B? This is a second question. A or B? Okay, let me know. Wow. Okay, from my screen right now, many of you pick A, 50-50. Okay, some pick B. Okay, from my screen right now. All right, interesting. So many of you pick A. Consistent, Norman. Thank you so much. All right. So many of you pick A in this regard. Okay. Now, so actually this experiment, right? So from the first test, we can conclude that when it comes to winning, right, most of you here answer B. Okay, sure win 500. So this experiment was actually conducted by psychologists Daniel Kahneman and Amos Tversky in 1979. When both of them conduct this experiment, asking people to choose between A, 50% chance of winning 1,000, 50% chance of winning nothing, and B, sure win 500. most of them pick B. Okay, when it comes to winning, right, most people are risk aversion bias. Okay, people tend to overweigh options that are certain and are risk averse for gain. So when it comes to winning, right, more people will sure win 500. So this is we'll pick this option. This is as of people who want to, when it comes to take profit, right, they will always take profit first. Okay, when it comes to like having 10% gain, 15% gain, they already take profit because sure win already, what, right? So this is when it comes to picking uh, uh, gains that are certain, right? People tend to overweigh options that are certain and are risk averse for gains. Okay. So now, second question, which one will you choose? Having a 50% chance of losing 1,000 and 50% chance of losing nothing versus sure lose 500. When it comes to this option, right, most people pick A. Like what the experiment that I conducted just now. Okay, most of you, 80% of you pick A. Okay, so this is also the same result that it conducted in 1979. Because why? Because when we pick sure lose 500, right, we are painful. Okay, so we confirm lose 500 a day, we might as well take a bet, right? We take a bet. Okay, we want to, we still got chance. Okay, if we have chance, right, we maybe won't lose anything. Okay, so when it comes to this theory, prospect theory, most people tend to have loss aversion bias. So people tend to take risks to avoid losing money. Okay, very true, right? Okay, like the experiment I do just now, a moment ago, most of you pick A for the second question. When it comes to winning, most of you pick B, sure win 500. Okay, so when it comes to sure win, right? Most people, when it comes to winning, most people have a risk aversion bias. Okay, when it comes to losing, most people have loss aversion bias. So people tend to take risks to avoid losing money. That's why we always see people sell the winner and keep the loser. If you look at the retail investor portfolio, what you will notice that most of them have a portfolio, let's say 6 stock, 5 stock is in red color, 1 stock is in green color. You know why? Because they don't cut loss. Okay, they don't cut loss. Okay, when it comes to losing, right, they want to keep the loser because keeping the loser, right, they still have hope. They still have hope that it can be turned around one day. Okay, so that's why people tend to take risks to avoid losing money. But if you look at portfolio of successful investor like Warren Buffett, do you think Warren Buffett portfolio is green or red? Obviously, it's green, right? Because when it comes to picking stock that he feels is wrong, he has made a wrong judgment, then he cut loss. Okay, he switched the company to a profitable, to a company that overperformed. Okay, that performed. Okay, so what we need to do is to follow. Okay, we want to do the inverse. Okay, we want to keep the winners and sell the losers. We don't want to sell the winners and keep the losers. Does it make sense to you? If it makes sense, okay, let me know yes in the comment so I know that it makes sense. All right, thank you so much. So remember, we have to do the inverse. Don't sell the winners, keep the loser, but we want to keep the winners and sell the losers. Okay. So this is a prospect theory conducted by in 1979. We noticed that when we make 100, this is pound, right? You make 100 pound, right? The happiness is only this much. But when we lose 100 pound, right, the pain of losses is even greater than the pleasure of making 100 pound. You get what I mean? You see, the sense of loss is greater when we lose 100 pound versus the kind of gain that we make when we make 100 pound. So this is, the difference between prospect theory. Okay, between when the feeling when you gain and feeling when you lose. So that's why people tend to keep the losers and then sell the winners. Okay, so this is exactly the opposite that we want to do. So losses impact larger than gains. So now when it comes to managing emotions, this is very instrumental. We need to manage our emotions so that we'll be able to weather through the stock market storms. Okay, so sometimes we have plan, but we never stick to our plan. We never stick to our plan, And then we let emotions cloud our judgment and affect our plan. So when it comes to investing, we must know how to how to manage our emotions. So what emotion do you feel when you invest in stocks? So there are actually generally 4 emotions. Number 1, fear. Do you feel fearful when the stock market crash? Like in the 2020 March, okay, in the March 2020 when the stock market crashed, okay, almost every few days, circuit breaker in the US, okay, also or leave it down in many stocks, okay. So when it comes to this thing, people fear, okay, people have fear in the stock market. Number 2, we have greed, right? We also have greed in the stock market. We want to make more money. We don't take profit when it is time to take profit, okay. We have hope. We hope that the stock will turn around, and then we always regret. Regret. Okay, so let's just delve into this emotion one by one. Okay, what is fear? Now, fear is when you get emotional about every little price action of the company that you just bought. Okay, fear is when you hear some negative rumors about a good fundamental company that you bought and sell the company short without doing much due diligence about the rumors. So this is fear. Okay, so when you invest with the money that you cannot afford to lose, then you will get very emotional as well. So if you're very worried, whether tomorrow it will go down or not, okay, you're very worried, at night you cannot sleep well because you heard your friends say, okay, now the now the ASP is going down, okay, so you're very fear, okay, for example, okay, so you cannot sleep at night. So read this. Fear is when you hear negative rumors about a good fundamental stock that you bought and sell the company short without doing much due diligence. So sometimes we read news, then we get emotional. So what we need to do is we need to cross-check with the facts. Okay, just you can go to Bursa Malaysia website and then see all the listed company announcement. They will know whether this is fact or not. Okay, so don't be too fearful. Okay, so long that when we buy into a good fundamental company, then just believe in your judgment. Okay, everything you do must be based on fact, not based on emotion. All right. So next is greed. Okay, greed is oftentimes we are very greedy. Okay, oftentimes we're very greedy. Okay, when we see the stock price go up, right? What we do? We don't. If the stock price has become overvalued already, and what do we do? Instead of taking profit, we top up. Okay, so this is greedy. Okay, so and then you actually buy more at the peak. So when it go down, you actually lose money. So this is greed. So when you buy, let's say, for example, you buy into a company, share price is 1 ringgit 40 cent. The EPS is 20 cent. So the PE is 7. So when the share price increase to 3 ringgit 40 cent, when there's no increment in EPS, but you don't sell because you still want to earn more, so that's greed. You get what I mean? So when the PE, when the valuation of the company has become overvalued, but you don't sell, you still hold on, okay, because you want to earn more. Okay, when will you sell? You only sell when it break even. When you count out more, and then you sell. So this is when people are overly greedy. So what you need to do is, everything must be based on fundamental. That's at least what I practice. Okay, so when the stock become overvalued, so that's when we need to take profit. Okay, don't be greedy and hold on to the stock. Now, hope is when you realize you have made a wrong judgment about a company or a company's fundamental deteriorates, but you still hold on to your paper losses, waiting for it to turn around one day. So this is hopeful, So hopeful is, every time when people become, when you see when the share price go up, okay, let's say share price go up, will you sell? Maybe you say you go up some more. Okay, let's say you buy a 10 ringgit. Initial you feel that when the price go to 15 ringgit, it is overvalued. You want to sell at 15 ringgit. So when the price go to 15 ringgit, you tell yourself that, okay, never mind. I will wait until I will sell when it go up higher to 16 ringgit, you will sell. So this is being greedy. It never stick to your plan. So when the stock go to 15 ringgit 98 cent, it comes down. Okay, then it go all the way to 13 ringgit. Will you sell? You won't, right? Because at 15 ringgit you did not sell. Will you sell? You sell at 13 ringgit, you look very stupid, right? So you won't sell at 13 ringgit because at 15 ringgit you never sell at 13 ringgit, you look very stupid. So you won't sell at 13 ringgit. So it come down to 11 ringgit. Will you sell? You're still with profit because you bought at 10 ringgit. Will you sell at 11 ringgit? You also won't, because at 15 ringgit you never sell. At 13 ringgit you never sell. Will you sell at 11 ringgit, you also won't sell at 11 ringgit because you will look stupid, ma. So when it go down to 10 ringgit, will you sell? You also won't sell because when profitable, you never sell. When you become break even, you sell, you look even stupid, right? So you also won't sell at 10 ringgit. When it go down 8 ringgit, will you sell? Or that time you will become hope already. You also won't sell because at profitable level you don't sell. At break even you won't sell. At loss making you sell. You also won't sell, huh? So it go down some more. Okay, go down some more from 8 ringgit to 6 ringgit, 4 ringgit. At 4 ringgit, during this time, right? From the process from 10 ringgit go down to 8 ringgit, go down to 7 ringgit. This is the time where most people will pray. Okay, they're hopeful. Okay, when you see that suddenly a lot of people go to the religious places like temples, okay, or go to the mosque, right? You know, stock market crash is coming already because suddenly everybody is spiritually connected to God. Okay, please, okay. So of course this is a joke, So when everybody become hopeful, one day will turn around. So this is, you know, the time where the stock market is bad. So you also won't sell. So when you will sell, you will sell at, let's say, 3 ringgit, 2 ringgit. This is when you're really hopeless already. You sell. After you sell at 2 ringgit, share price rebound to 10 ringgit. Okay, so then you want to kill yourself. Oh, okay, why I made this mistake? Okay, so this is what happened. The emotions. Okay. Now, hope is when you invest in companies without doing much due diligence, merely hoping that the lady luck is with you. You hope that the stock price will recover back from loss-making positions, and when you are in profit, you hope that it will run even further. So this is greed and hope together. Regret is when you notice that the share price still goes up after you sell your stocks. Okay, regret is when the share price still goes down after you buy the stocks. Okay, now every time buying the stock is actually a very logical process, but selling the stock is another level of skill. Okay, now every time when we sell stock, right? So oftentimes we say that the buy process is a science. Okay, the buy is is a science, but sell is an art. Okay, the sell because every time we sell, right, we have emotions. But every time after we sell, right, if the share price still go up, right, then we have regret. We should have sold a bit later one. Then we make more. This is a regret, lor. So regret is also when the share price still go down after you buy. After you buy, right, you say, share price still go down. I buy early already. So regret buying too early. So these are another emotions that you will feel when you. So the thing is, after when you sell, right, remove the stock from your watch list so that you won't feel emotional. Because after you sell, right, you see the share price still go up, maybe you're itchy, you still want to buy some more. Okay, so you know, so the best is after you sell, right? After based on fact, right? You feel that this stock is overvalued, you sell, then remove it from a watch list. After maybe 2 weeks later, you only see So because otherwise you feel emotional about that. Okay. Now, so here are the emotion through the investment cycle. Okay. Now, initially, this is very common. Okay, you will see that, okay, wait, this is a uptrend. It's uptrend. Okay, you say that it's uptrend. I will go in when it goes up a bit more. So when it go up a bit more, you say no more waiting here. Here I come. Okay, you buy here. After you buy, right, the price go down. Then you say, I should have waited a while more. You regret buying too early. Then when the share price recover, you say, yeah, you are making money. Then at this point, you haven't take profit yet. Then it comes down. It's a correction period. Okay, let me put more now. Okay, then at this stage whereby the price is lower than your purchase price, I will sell off when it break even. Okay, then it come down some more. Sigh, I'm stuck. Okay, you're stuck here already. And come down some more. Gosh, I'm leaving. Okay, at this point, you are at this period is where you are still hopeful. You hope that it will turn around. At this point, it's devastation already. Okay, at this point, you're actually hopeless already. Okay, you're already depressed in the depression state. So you say, all right, I cut loss already. This is probably you lost maybe 60%. Okay. Then after that, go down some more, you say, wow, hang. Okay, luckily I sold off early. Okay. Then after that, it go up, you say, some window dressing. Come down, you say, I told you so. Then it go back up, you say, is this serious? Oh, go back up, market is crazy again. This is it, I knew it, I'm coming in again. So you see, when you're following this emotion, right, you always buy high, sell low. You always buy high and sell low. Okay, so one thing we can do is, we have to have an investment plan. You must have an investment plan and tell you, we let facts become our guiding beacon in the world of investing. Okay, when we will know that, or this stock, let's say you study the company, so that this stock actually the value is 2 ringgit. I want to buy it at 1 ringgit 50 cent. So the plan is to buy 1 ringgit 50 cent. Only buy when the stock price go to 1 ringgit 50 cent. So you stick to your plan. You say this stock is overvalued when it becomes 4 ringgit. Okay, you want to sell at 4 ringgit. So your selling plan is 4 ringgit and stick to that. So one trick to overcome your emotions is to have an investing plan. Okay, everything based on plan facts. Okay, don't based on emotions, because emotions will cloud our judgment. So managing your emotions, you have to have emotional detachment when it comes to investing. We need to be disciplined and follow your investment plan. You need to have discipline. Don't invest with the money that you can't afford to lose, because when you invest with the money that you can't afford to lose, you will get very emotional, because this could be money that you need to save for your down payment for a house. This could be money that you save for your children education. This could be money that you want to save for your retirement funds. But when you invest in this money that you cannot afford to lose, then every day you'll be very emotional as you glue your eyes to the stock market price movement. 3, don't chase the price, because if you miss a price, let it be. Opportunities are everywhere. Okay, move on to a new company or wait for the price to come back down. Chasing the price is a symptom of greed. Okay, so this is some tips when it comes to managing emotion. So remember, no matter how good you are, there will be stocks that you will lose money on in the short term. So have faith in the judgment and keep holding on. The key is to make losses small part of your portfolio and profits big part of your portfolio. Losses are just costs to make profit, just like managing a business. When you manage a business, you still have costs, right? You have your variable costs and your fixed costs. So these are just so managing a portfolio, you still have some stock that will lose money. Okay, so just remember, losses are just costs of running a business. Okay, so the key is to make your losses small part of portfolio and profit big part of your portfolio. So when it comes to investing, when you make money, is like you are like this. When you lose money, you're like this. Then you are not on track to successful investing. You're on track to successful investing when you make money, your facial expression is like this. When you lose money, your facial expression is also like this. Okay, so this is when you're on track to successful investing. All right, so it means that you have no emotions. Okay, make money, you're like that. Lose money, you're like that. It's not like when you make money, you say, okay, like I belanja, okay, I treat you, okay. When you make money, wow, you eat, you eat buffet, okay, you spend lavishly, and then when you lose money, right, you become very depressed. So this is not, a trait of a good investor. Okay, an informed investor is when you lose money, no emotion. When you make money, also no emotion. Okay, so this is on track to successful investing. All right, so I'm done with this segment. Informed investing path to wealth creation. Okay, now if any question you want to ask me, you will be you can type in the Q&A box. I'll be able to address your questions. So right now we still have about slightly more than 10 minutes. Okay, sorry, slightly more than 15 minutes to answer question. All right, I'm seeing many questions on my screen right now. Wow, many people say that sounds like your experience. Okay. All right. Yeah. So this is what retail investor always feel, huh? Will there be a replay as you need to go to work? Yes, there will be a replay recording sent to you tomorrow. What is an investment grade company? So this is asked by Izudin. Thank you so much for the questions. What is an investment grade company? Investment grade company is a company that we classify as a blue chip. Okay. Now, blue chip companies, investment grade companies are companies that have a historical track record of running the business. They have a proven business model. They have a large customer base. They have a solid distribution channels. They have a strong track record of making operating profit from the business. So these are the investment grade companies. Okay, companies that have solid fundamental, they have growth prospect, and they are stable. So these are what we call an investment grade company. All right. So one of you are saying that if I have lost 90% in a stock and stock capital portfolio is 50%, I have another stock paper loss 50-60%. So now the portfolio is left 25%. Wow. So what should you do? Well, this is a very tricky situation. This is because if your portfolio is now only left 25%, right? Then you must ask yourself, is the stock that you're holding on right now has solid fundamental or not? Do you think in the next economy cycle it will go back up or not? Okay, or do you have a better stock that you can invest in? If you feel that these stocks that you are holding on right now are of solid fundamentals, then of course you can still hold on. Okay, when the next cycle come, then you will go, then you move on. Or if you have other better opportunity elsewhere, the stock that's maybe on momentum, then you can also switch. So it all depends on you whether you should cut loss or not. It depends on what kind of stock that you hold. Okay, but of course it is a out of money warrant, and if these are warrants that are near expiry, then obviously you have to cut loss already. Okay, if it's warrant near expiry, then you have to cut loss already. No, don't hold on. If it's warrant that's less than maybe 2 months, then maybe you're in paper losses right now, then I think you should cut loss already. That's for warrant. If your stock, then it depends on what kind of stock you hold on. If this is a company that are experiencing short-term negativity, then you may hold on when the tide is turns around. If it's a bad quality company, then cut loss. Okay. How do you determine if a stock is overvalued? Okay, now this is a very good question asked by CEO. Now, thank you so much for the question. Now, how do we know that if a stock is overvalued? Is we can use a normal, most retail investor would use a more common valuation ratio, which is we use PE ratio, or we use a PB ratio to know that whether this stock is overvalued or not. So if you want to benchmark the PE ratio, we benchmark against the industry peers. So let's say if you invest in let's say a consumer staple stock, then you benchmark it against other companies in a consumer staple industry to see what is the PE ratio. If the average PE ratio is 20 or 25, then in stock PE ratio is now 35, then this is overvalued. So we can do two comparison. Comparison number one is compare with their historical PE. Let's say you invest in company A. Company A, over the past 10 years, the PE ratio is always, let's say 20. Okay, and the lowest PE ratio is, let's say 15, highest is 25. Then if the stock price right now is doing a PE at, let's say 25, then it's overvalued because it's at the 10-year high of the PE ratio. So this is one way you can compare with the stock historical PE ratio. The second way you compare is compare with industry peer. Like I say, if the industry peer is doing at 25, this stock is 35, then maybe it's a bit undervalued. So these are two ways that we can compare. Okay. All right. So let me see the next question. Let's see. What do you think about the Malaysian market right now, given the uncertainties in the political situation? Wow, this is about market outlook. Yeah, I think we are still above the 1,500 points. Today I didn't see because I started the webinar at 9 o'clock, so I did not see the market performance as of now. But since I Bursa Malaysia later, I just check what is the point. But I would think that the uncertainty is still there, given that the political situation is still unstable with the rising COVID-19 cases. So as of the moment, I think I would advise investor to not be aggressive, but stay on the defensive mode. Ideally, invest in companies that are defensive in nature. The company business performance will not be affected so much, even though it is the pandemic. Okay, so business performance will still be here. even though pandemic outbreak becomes serious. So don't invest in companies that the pandemic will seriously affect, will adversely affect the company's performance. Okay, so we have political uncertainty right now, when our opposition leaders saying that they have numbers, but then there's no, we don't know what will happen, what will unfold in the political scene. So politics looks a bit more unstable, and then the COVID-19 cases will also is on the rise. So right now, I think safer for us to be defensive, have more cash position in your portfolio. Don't be 100% invested. So this is my some of what I think I would do. Okay. So next question. For startup capital, if you are a beginner, right? Let me read your question. If I understand correctly, if you have a small startup capital, which asset class or type of stocks that you should invest in? Okay. Now, if you are a new beginner and have a small capital, then for you to build confidence, then you can probably look at income stock or blue chip stock or defensive stock. Okay, income stock are stocks that give high dividend yield. Okay, so for example, Bursa Malaysia is a company that give high dividend yield. You can invest in Bursa Malaysia, or invest in Amway, also give high dividend yield, for example. But REITs, I'm saying company that declare high dividend yield, REITs. Okay, also maybe Maybank also give quite high dividend yield, or even though maybe temporarily may not give so high dividend yield for the moment for the bank. So you can look into all high dividend yield stocks. So this is number one for beginner investor. Buy into real estate investment trusts or stocks that give high dividend yield, so that when the share price go against you, then you will still be you won't still feel fearful about that, because you still receive passive income, right? So number two is buy into defensive stock. When you buy into defensive stock, right, good time, bad time, the business performance will still be there. For example, it could be utility companies, consumer staple company, or even healthcare company, because good time, bad time, people still need a healthcare. People still need to buy, do grocery shopping. People still need to use electricity. Okay, so these are defensive company. Good time, bad time, the business performance will still be there. So these are second type of classification of stock that I can go into. The third is probably a blue chip company, because these are investment grade companies. They already have a long track record of history of operating profit. Then you can also invest in. So these are stocks that are more stable. Okay, usually big cap lah. If you are a new investor, you can invest in this company. Focus on the big cap. Don't focus on the small cap, or don't focus on the growth stock from the ACE market. Okay, so if you ask me, I think for a new investor, right, slowly build confidence through a safer stock and build stability first. What if the company is high dividend yield, but the company profit is on downtrend? Should we continue hold? This is by Evelyn. This is also another good question. Now, personally, right, of course, I'm talking about personal. Personally, if the company have a high dividend yield, but the profit is on a downtrend, I won't hold. Okay, this is probably the case for, let's say, Amway. Company profit, performance not so good, but then the yield is okay. So I personally would not hold on to this company, because to me, capital gain is equally important. When the company profit decline, right, it is a symptom that this company may not be so profitable, because everything that is reflected from the financial statements can tell you what is going on with the business. Okay, it means that they could have a higher operating cost, or their sales also decline. So if the company is on a profits on downtrend, but the dividend yield is still okay, personally I won't hold on. Personally I won't hold on. Okay. So Victor asked me, what is the best investment strategy that works well for you over your investment period? Well, I maintain quite a balanced portfolio. Okay. Personally, I am still a bit young. Okay, so I have most of my stocks are in growth stocks. Okay, I have 70% in growth stock, 30% in more stable stocks. That's for me. So I would want to, because I'm still young, I want to deliver a higher return to my portfolio. So for me, I go after all the high growth counters. Most of my portfolio are in high growth counter. Well, 30% is for stability. Okay, going into companies that deliver that will stabilize my portfolio performance. So that is my portfolio composition, and my strategy is always go after undervalued stock and also high growth stock, but it is not over expensive. I go after high growth stock, but they are not overly expensive. High growth stock that are doing at fair valuation. If I buy into high growth stock, I won't expect it to be undervalued, but I want it to be fairly valued. I don't want to buy into high growth stock that are overvalued. So that's my strategy. When I go after high growth stock, I look at stock that are growth stock that are fairly valued. It may not need to be undervalued, but so long as fairly valued, but every quarter the earnings still support, then it go up. For undervalued stock, for stability, I will go after undervalued stock. Stock that are trading below their book value, stock that are trading below their average PE ratio. So that is my investment strategy. All right. So I guess this is time for us, to call it a day. All right, so I want to thank all of you here for spending your precious morning with us this morning in conjunction to the World Investor Week. Bursa Malaysia has already rung the bell, okay, to signify the opening of the market today. So we want to thank Bursa Malaysia for doing this webinar segment. I want to thank the CEO of Bursa Malaysia, Dr. Omar Swift, for delivering an opening remark prior to this the start of this webinar. Okay, so with that, thank you everybody for tuning in to this webinar. I hope that today you walk away with some valuable tips. Okay, today is not a heavy topic. Today is more on mindset change, and also some of the emotional techniques, and also some of the common mistakes. So you walk away with some of these techniques, and know that do your own self-assessment. What kind of mistake do you make in your investment journey, and how you can avoid making this mistake again. So with that, see you all tonight. All right, this is Choo signing off. Bye bye.